We are back now. The keynote: how family offices are attractive to startups, not family offices. How family offices are attractive to startups. So the keynote by Samira Salman. She is the COO Heathside Ventures from US. She is a leading business advisor, domain expert in private direct investments, and sought after thought leader, speaker. She is the co of Headside Ventures, a single family office, and the founder CEO of Salman Solutions, an advisory firm that provides proprietary end-to-end solution for investors and management teams needing expertise, augmented capabilities to grow their companies and portfolios. Over to you, Samira. Go ahead.
Thank you, Rajan. And welcome to everybody who's in the audience. I really appreciate the opportunity to speak here. I wanted to invite the audience to send me questions as I'm speaking because I love to have an interactive dialogue. And since we have a very small group, I think it would be great if we could learn from one another and share with one another. So feel free to send me questions as I'm speaking. So I wanted to, before we get into the details, I wanted to talk a little bit about some of the trends that are happening currently in the family office space in direct investing and startups. So there are multiple different studies. One came out of the World Bank in partnership, World Economic Forum in partnership with JP Morgan Private Bank. And the study indicated that 60% of the private family office funds that are invested in alternatives are being reallocated from funds into more direct investments. In addition to that, UBS did a study with Camden that said 46% of family offices are making more direct investments. So, between 46 and 60%. So that's a pretty significant number of families to start looking more into private equity and direct investments. So I think what is helpful for all of us is I'll just share what I think are the different ways that families should look into making direct investments and into investing in startups. And then we'll talk a little bit about the pros and cons between startups and funds. And again, if anybody has any specific questions or wants to share a personal experience with families or investments that they've received, I think that would be helpful for the group. So I look at direct investing and investing in startups as you need three main things. You need a really good process for your family office. You need the right kind of support for your family office. And then you also have to be able to add value. The process of making investments should be set by your family office team, and you should have a very diligent checklist. Should not deviate from this checklist. Of course, you can enhance the checklist, and you should add to the checklist each time after you engage in a transaction, and you can, add it or take away from it as your experiences show you. But I think what's really important is to think about the process of making investments directly and into startups as a scale on a continuum. A lot of families just think about diligence, but I think it starts before that, way before that. First, you have to have a great process for sourcing different deals to look up, to invest in. Select, diligence, structure, grow, turn around, troubleshoot, problem solve, and then exit. That's the entire continuum of investment. So I'll say it again just to be clear. Source, select, diligence, structure, grow, troubleshoot, problem solve, and exit. You should have a process for each of those components, and I'll go into them a little bit more in detail. So the second category is support. You really need to have support if you're going to make private direct investments. What do I mean by support? You can either have the support in-house, which means you have you have a team. But I really mean outside support. I mean your global network. And that's one of the reasons I think that this group is great, is because Rajan has really focused on the fact that in his presentation at the beginning about building a community and a network. So even if you're a super sophisticated family office and have a large internal team, nothing takes place of the experience. So if you can partner with other families that have done deals in the sectors in which you are interested, that provides you an additional support system. My personal viewpoint is that it doesn't matter if you know how to do a certain type of deal or if you have experience in a certain industry. If you know who to call, that can either help you answer the questions, provide some of their background and experiences, or, they've done a certain type of deal in, the biotech industry 20 different times, and they can very easily look at the transaction you're contemplating. Even if you don't have a lot of experience with it, you can lean on others' experience. So in addition to your own internal process as a family office, you need to build out your global support network. And again, you will have internal support. You might have analysts, deal teams, very experienced private equity advisors, and that's all fantastic. But I would couple that with external support. And the way that you build an external support network is by attending events like this, networking, and developing trust. Trust is very, very important to build with like-minded families. You want to build rapport. You want to make sure you have shared common interests, and start building the relationship. So when you have the opportunity to look at a transaction in a certain space, and you've built a relationship with somebody in that space for the past couple of years, then it will be easy and comfortable for you to call them and speak to them about the opportunity and to rely on their viewpoint and experience. The third component that I think is really important for families when making private direct investments, investing in startups, tech investments, is you want to be able to have some type of a value add to the investment that you're making. What does that mean? That means you should invest in what you know and what you understand and what you can help grow. So if it's an industry in which your family's wealth was made, or the family you work for's wealth was made, or you have a background in that, that's a really helpful resource. In addition to that, you want to think about, can you make business development calls on behalf of this company? Do you have the ability to help support the management team by sitting on the board? One of the most important things to remember when making investments is that people run companies. Okay, so even though an investment might be very attractive on a spreadsheet, it could be a pure type of spreadsheet business, and you can look at the numbers and you can see, if we invest this, then these 5 things will happen, and then we will have these returns. And that's fantastic, except for businesses are still run by people, by human beings, and human beings sometimes have challenges and they need support. So one of the things that we do, so the family that I work for, it's the grandson and I, and we run the family office, and we make mainly private direct investments in sustainable technology companies. And one of the things that we do is we align ourselves with the management team very early on. We build relationships with them, and we get to understand who they are and what type of support they need. We do sit on boards actively when we can, and we roll up our sleeves and we start doing the work with the management team. So being able to add value, to provide support, to lend an ear, to make phone calls on their behalf. As many of you may have experienced during this pandemic, your portfolio companies needed a lot of support. You had to triage immediately and make very difficult decisions. Sometimes we had to shut down divisions or offices. Sometimes we had to, unfortunately, furlough employees. There were times when we had businesses that were essential businesses with essential workers, and we had to make some quick decisions. So in situations like this, the more eyes and ears and sleeves rolled up and people actually helping do the work, the better. So, my invitation for everybody is, remember that when you invest in a company, you're investing, now your capital is being given to the management team. So the better that you can align yourself with that management team, the more successful that you're going to be. You want them to call you before the company starts having real challenges. I'll use a very recent example. It was probably a couple of years ago now. I keep forgetting that we lost an entire year in 2020. But so we received a phone call from one of our private direct investments, one of our portfolio companies. And the management team said to us, "You're our largest investor. We've spent half your money. We're having some challenges and we need some help. Can you please come in and help us?" We said, "Absolutely. We're very happy to come in." So we scheduled a meeting. We went to the offices. They were all sitting around the conference table. And they said to us, "We've spent half of your money already. What would you like us to do with the other half? Would you like us to give it back? Because we have all these challenges. We don't know how to fix them. Do you want to help us try and fix the challenges? Do you want to, work with us and ask us some questions and make decisions?" They said, "Look, we're open to whatever suggestions you're going to make for us because you are our largest investor." And we said to them, "First of all, thank you for calling us before you spent all of our money," right? But then the next thing we said was, "We wish you would have called us a little bit sooner." They had been, giving us regular updates via email and those kind of things, but we hadn't had a really deep dive. And at the end, what it turned out is there was some relationship issues between the co-founders. And so once we were able to solve that, we were able to get the company back on the right track. So again, this is the type of situation where being able to add value to a management team, providing support, providing resources, making phone calls on their behalf, I think is a very valuable component. So let me back up again and talk about, my 3 kind of guidelines. So you want to have a really good internal process for how your family selects, sources, diligence, structures, and exits your private direct investments. You want to build a global support network. Both internally, you want to have a good internal team, but even if you're a smaller family, with our family, it's just the grandson and I who run the family office, but we have a really well-established, deep global network of other families and experts who invest in areas that we're interested in. And we're constantly out there networking and building relationships. Our deal flow comes from our global network of like-minded, similar families. We find that once deals have been or at an investment bank or other institutions, then they've kind of been picked over. We would rather get deals that have been not on the market that long and are already backed by a family or several families, and we get phone calls from our network. So having a global support network is really important. And then obviously the value add. I want to talk a little bit about the pros and cons of family office capital. This is if anybody is a startup or is are on the founder side. Of course, the pros of family office capital is it's very patient capital, much more patient than fund capital. And it's really useful if you need to prove out a concept or if you have a slower, steady growth pace type of business. It's also really great for tech-enabled like asset management or service businesses where you're providing a service that you can ramp in a very respectful manner, but it's not going to necessarily have hockey stick uniform growth. It's also really useful capital when you're solving a problem and you're enabling the solution via technology. So what that means is that, it's not necessarily a tech build, but it's a solution that is tech enabled or tech supported. And it's usually really great capital, family office capital, when you're blocking and tackling, and it's slow and steady wins the race, and you're trying to take the time to scale the business. And making direct investments into startups and technology companies and private companies for an investor, it's a really good benefit if you're looking to compound over time. Okay, if you're looking to invest your capital and get it out quickly with a massive return, well, private direct investment is not necessarily the way to go. On the flip side, the cons to receiving family office capital is sometimes, depending on the family, they may not be as sophisticated or have as many connections as maybe a venture capital fund. So what I tell companies and founders and startups who are looking for capital, you have to really be sure that you're getting the right fit. In the entire continuum of capital, there are venture capital funds, private equity funds, angels, friends and family offices, and each debt, and there's, those are debt, and then there's equity, and then there's combinations of both. There are many, many, many different types of capital that you can secure to fund your business, and many capital structures in which you can fund your business. It's very important you get the right fit for your business. If you're a technology company that is needing to own the market before your competitors and to blitz scale and to grow at a very, very rapid pace, well, then perhaps you need to look at venture capital funding from funds and set yourself up for success that way. If you're a business that knows that you have, you have some product market fit, you have some scale, but you're still trying to figure things out, or you need to build and onboard a team, or anything that means slow and steady growth, and you can't guarantee that when I invest in you, you're going to accomplish these things immediately in this time frame, well, then perhaps you need to get family office capital. So I see we have a question here. I'm going to stop. So how do the family offices evaluate startups for investing, and how far is direct investing catching up with family offices? So these are all great questions. What I will say is, and I'll just share my experience. So my background is I was a corporate tax M&A structuring lawyer. So I was a deal lawyer. I diligenced a lot of companies. We structured a lot of deals. We did turnaround work, M&A, and exits. And what I will tell you is, you want to have a really good diligence checklist, and do not ever deviate from that checklist. We have story after story after story of, they checked 49 of the 50 items, they missed one item, we invested in it anyway, and that one item that we missed is the reason the company didn't succeed. They're not necessarily our stories, but from other families, we've heard of this. So the first thing is, you want to have a really good diligence criteria checklist. You want to ask all the questions, and you want to make sure everything gets checked off. But, and here's the really important but, and I always say this, your gut is your most important investment tool. Our diligence checklist, our criteria, our analysis, calling our friends in our family office network and asking them what they think, those are all additional data points, okay? They're data points, but they should not make your investment decision for you. When you make an investment decision, use your diligence checklist that you've edited each time, so you're adding questions as you look at companies. Talk to your friends, and if all of that checks off, then you still want to listen to your gut. In my experience, even if everything checks off on the checklist and all your family office colleagues say, this is going to be a great investment, if your gut says something's not correct, you need to listen to it. And it's on the flip side as well. If you check off everything on the checklist, but people are a little bit wary, and most people are like, I don't know, that seems a little risky, but you feel in your gut, you know that it's going to work and you think it's going to work, then again, go ahead and make that type of investment. The family that I work with, the grandson is very entrepreneurial and he has a fantastic gut, and he can see, if you put 20 things in front of him, he can see, I think these two are going to work. That's why we work together. I'm the same way. I came from tax and legal and accounting, and I do all my checklists, but then I follow my gut. And there have been times where even if certain components aren't exactly clear, you believe that the team will be able to solve it. Because remember, people invest with people. People they like, people they trust. They always have and they always will. This is something that I think is super important when you're, especially when you're a family making private direct investments. Make sure the chemistry and the energy and the synergies are correct between you and the founding team, you and the management team, you and the additional board members. You want to put your capital in situations that also work for you personally. If the people are interesting, if you think they're hustlers, if they're very respectful, they communicate well, these are all great signs that you're going to have a great professional relationship. Because the reality of the situation is 9 times out of 10, when you make investments, you never get the return exactly the way the projection said. That's not how it works. So at some point, you're going to all be sitting together with your sleeves rolled up, problem solving. That was the difference between the companies that made it and didn't make it in this pandemic. If they had a nimble investment team and group of investors that could get together, they liked each other, they had rapport built, and they could have a discussion about, okay, how can we help them? What can we do? And everybody's getting along well. Well, then we're able to make quick, good, healthy decisions for our portfolio companies. But if there's friction among the advisory board or the investors and the management team, it makes it a little bit more difficult to troubleshoot and problem solve. So, my biggest advice that I can give is that you need to have processes. You need to build a global network of support. You need to feel like you can add value. But at the end of the day, people invest with people. People they like, people they trust. So what we tend to do is we make close relationships with like-minded families, and then we look at deals together, and we have that synergy built with the families to understand, how do they look at items? How do we look at items? And once you've done that a couple of times together, you get a comfort level with each other. And what it allows you to do is to rely on, so you don't individually have to do all the diligence and, put the whole structure of the deal together. So really knowing who to call and building that global network will help you make better decisions. I think I might be up at my time, Rajan. Is that accurate? Can you hear me?
Yes, you could hear me.
Hello?
Yeah, sure.
Oh, yes. Okay, there you are. Sure. Yes. Okay, so I was just going to open it for any more questions.
There are 4 questions. So.
Yeah, perfect. Okay, let me open the questions. All right. Okay, let's see. Family offices look for social impact or ROI when they invest in startups. Oh, it's a really interesting question. So, the viewpoint that our family takes is that you can make socially responsible and impactful investments and still receive a return. There are 2 components to that. You need to look at, use the same evaluation criteria for a social venture impact company as you do for a for-profit company. Do they have a good team? Do they have a strategy and game plan? Do they have traction? But in addition to that, you want to look for flexible capital structures to be able to support that level of growth. And you want to look for ROI metrics that are outside of a spreadsheet. So for instance, and I can't remember the name of the university, but it's in Pennsylvania. And what they did was they created a whole set of metrics, but maybe it was Elizabethtown or Elizabeth, something like that. They created a whole set of metrics for you to be able to analyze a social venture to see if it was going to have if you would receive a return on your investment, not necessarily a financial return. So I think before you look at social impact companies as a family office, you need to have a clear definition of what does return on investment mean for your family. Is it just we want a financial return on our investment, even though it's a social impact investment, but we still want returns of X percent or Y percent? Or are you looking for a return on your investment that says, we want to impact these many lives. We want to bring clean water to these many people. We want to help these many women get screened for breast cancer. You have to make a definition of what a return means for you and your family before you go and start looking at things. Because what will happen is you'll get very passionate about and excited about certain companies and projects, and then you won't really know how to properly evaluate it. The other thing that I invite families to do is to look into making mission-related investments if you have a family foundation. So if you have a family foundation, you can put vehicles, structure vehicles within the foundation that can make direct investments into types of companies. Like, not everything has to be financial investments. You can carve out a certain piece of your corpus. I mean, obviously you need to make sure that if it's a foundation, you're still granting out 5% and you meet all those rules, but there are ways to be a little bit flexible with the capital. So hopefully that answered the question. And then, how do the family office evaluate startups for investing? So, every startup needs really 3 things to be successful. It needs a really good game plan and strategy on how to grow. It needs a team to execute that, and it needs capital. Okay? Take the capital away. What do I look for? I look for a solid strategy and a team that can execute. Even if the team is not already identified, I want the existing team who's asking for my capital to be able to communicate with me and say, we need money because we want to hire this person, and this person. And when we hire them, we're going to do these 5 things. And these 5 things are going to yield these 6 results. And here's how we're going to measure the results. And if we cannot achieve these results, then we're going to try these 6 other things. I need to know that you have thought through the plan 6 ways till Sunday, and you have a plan A, a plan B, a plan C, a plan D. And you've done the research and homework around it. So one of the things that we really look for is we look for the thinking behind the plan. I want to show your work. Remember in 5th grade, if you did your math problem and you got the right answer, but you did not show the correct computations, you didn't get full credit? I am looking for the thinking, because the plan and the strategy is never going to happen the way you tell me it is. But I want to see, can you think about how to pivot around these problems, because problems are going to happen. So 9 times out of 10, we're looking for a very well thought out plan and a management team that we think is nimble and can think on their feet and execute the plan. You need to break things quickly, and you need to make quick, nimble decisions. I'm working on a project right now with a family. We have a substantial amount of capital in a business. It is a boutique fitness company that had 3 fitness studios in Manhattan. Those studios were shut down on March 16th. That was the last time we were allowed to have physical classes. This team nimbly pivoted, and in 3 days they were in revenue, and they were able to replace 50% of 2019 revenue in 2020 with all their studios shut. Okay? Meanwhile, a bunch of other fitness studios are closing and going out of business. What is the difference between those 2? They're both fitness studios. They both have physical locations in Manhattan, but the one with the team that was able to nimbly, quickly pivot is the one that succeeded. So you really want to invest in the humans, because you can see the same business plan over and over and over and over. They all look the same after a while. So pick the team, bet on the jockey, not on the horse. Pick the team that you think is the smartest, fastest, most, respectful, responsible. That's who you want to put your money with. Let's see. Okay, how far direct invest? Far, okay. How can startups add value when family offices start investing in them? So I think one of the main things that startups can do not only is to be very communicative with the families and all of their investors for that matter. There should be a regular cadence of communication. I sit on the board of a company. It's called Chisos. The founders are fantastic. They provide us a monthly updated email, and we also have a quarterly investor meeting via Zoom. And in addition to them updating us and asking us questions and allowing us to support them as startup founders, they also connect us to each other and make connections for us and help us with things that they know that we are working on. So I find that founders that really respect the fact that we're not just an investor, we're not just a check to you, but we're also business people who are doing other things and helping to add value that way is a really fantastic thing. So I think, Rajan, I've answered all.
I think it's okay. Next in the panel, we could take some questions. We have the next session.
Okay, perfect.
It was a great insight. You've given a lot of interesting opinions and real practical decisions how to make for family offices. It was great. Thanks.
Thank you.
Look forward to the panel. Thank you.
Thank you.